The stock market, for all its sophistication and structure, is an unpredictable force. Investors, whether new to the game or experienced, often find themselves caught in its volatility. Despite countless strategies, financial models, and predictions, the stock market remains an enigma. What exactly drives this unpredictability, and why is it so difficult to master? At the heart of stock market volatility lies human psychology. Emotions like fear, greed, and hope are powerful forces that shape decision-making on a daily basis. These emotions often lead to irrational behaviors, buying into a stock during a surge out of fear of missing out or selling in a panic when prices unexpectedly drop. These emotional swings create erratic market movements that no amount of data can fully predict. Consider herd behavior. When a stock begins to rise quickly, more investors jump in, driving the price higher. Conversely, during a downturn, fear spreads and investors sell off in panic, exacerbating the losses. In these moments, human emotion overrides logic, and the market becomes more unpredictable than any financial model can account for. While human psychology is a significant factor, there are other hidden forces at work, namely market manipulation and insider trading. These activities create fluctuations in stock prices that have little to do with the underlying fundamentals of a company. Market manipulation can occur when powerful entities, often large institutional investors, artificially inflate or deflate stock prices through false or exaggerated information. A common tactic is the pump and dump, where manipulators drive the price up with hype and then sell off their shares once the price peaks, leaving smaller investors with losses. Similarly, insider trading, where individuals with non-public information about a company make trades based on that knowledge, further distorts the market. These hidden activities undermine the integrity of stock prices, making the market even less predictable. In addition to psychological and manipulative factors, the stock market is also vulnerable to external forces, such as geopolitical tensions and global events. While these factors may not always be immediately visible, their impact on stock prices is profound. Consider the effects of a political crisis or a trade war. Events like the U.S. China trade tensions or geopolitical instability in oil-producing regions can lead to global economic shifts, triggering drastic price fluctuations. Similarly, pandemics, natural disasters, and major financial crises introduce uncertainty, which in turn causes market swings that can't be anticipated by traditional analysis. In such cases, market reactions tend to be swift and unpredictable. Investors, reacting to uncertainty, may overcorrect, leading to price swings that do not always align with a company's performance or earnings. These external disruptions add an element of unpredictability to the market, one that models and predictions often miss. Economic indicators like GDP growth, inflation rates, and employment figures are commonly used to assess the health of an economy, and by extension, the stock market. Yet, even these seemingly concrete data points are not immune to misinterpretation. For example, a strong jobs report might initially boost the stock market, but if investors believe that rising employment could lead to higher interest rates, the same data might cause a market downturn. The reaction to economic reports is often driven by perceptions and expectations, which can lead to market overreactions or underreactions. Such misinterpretations of economic data further highlight the unpredictable nature of the stock market. Economic reports may not always provide the clear, actionable information investors hope for, leaving the market vulnerable to incorrect assumptions and wild price movements. To account for all these variables, analysts and investors use predictive models, ranging from technical analysis to advanced algorithms. These tools aim to forecast market trends and predict stock price movements. Yet, despite the sophistication of these models, they often fall short of accurately predicting the market's true direction. The main reason for this is the multitude of factors at play: human emotions, manipulation, global events, and economic misinterpretations, all of which are difficult to quantify. No model can fully account for the irrational behaviors of investors or the unforeseen consequences of geopolitical events. Predictive algorithms may offer valuable insights, but they are not foolproof, and they can't eliminate the inherent uncertainty of the market. In the end, the stock market's unpredictability is not a flaw or anomaly. It's a fundamental characteristic. Whether driven by psychology, manipulation, or external forces, the market is inherently uncertain. This unpredictability is precisely what makes investing both risky and exciting. As investors, we must come to terms with this uncertainty. The goal isn't to eliminate unpredictability, but to learn how to navigate it effectively. A calm, calculated approach, rather than relying solely on predictions or market timing, is often the most effective strategy in managing the stock market's inherent risks. By understanding the hidden forces that drive market unpredictability, investors can make more informed decisions, reduce emotional trading, and embrace the uncertainty with a sense of calm and control. The hidden forces that make the stock market unpredictable are many and varied, but they are all deeply connected. Whether it's human emotions, market manipulation, geopolitical events, or the misinterpretation of economic data, these forces create a volatile environment that no one can fully predict. Yet, by acknowledging the unpredictability and learning to navigate it with patience and strategy, investors can better position themselves for long-term success.